Welcome back, everybody, my business enthusiasts. My name is Dr. Kasha Suarez, and I'm here to share with you all things with buying and selling online businesses. If you've ever wondered how investors, buyers, and even business owners determine the value of a company, you're in for a treat. In this video, I'm going to demystify one of the fundamental methods used in business valuation: calculating multiples. So stay tuned, because at the end of this video, you'll have the knowledge and the tools to assess the worth of any business confidently. If you haven't already done so, make sure you hit the notification button and the subscribe button. And if you're ready to begin, let's get started. Before we dive into the strategies of calculating multiples, let's establish a firm grasp of what business valuation truly is. At its core, business valuation is this multifaceted process that helps you determine the economic value of a business or a company. Think of yourself like a detective and you're figuring it out. The valuation process is a critical purpose that helps give you the view of the business landscape. Business valuation is actually instrumental in mergers and acquisitions because it enables companies to make informed decisions in negotiations and also assess potential synergies. It's also the foundation for making good investment choices and then guiding buyers and investors to be able to gain or find that capital wisely. Additionally, accurate business valuation is important for financial reporting and ensuring the transparency and trust among stakeholders. Now let's explore the concept of multiples. This is that hidden treasure chest in the world of business valuation. Multiples serve as a foundational piece in this world of business valuation. These metrics, they typically extracted from financial data, enable us to gauge a company's worth. And you're able to take the multiple and pin it against similar businesses in the market. These financial metrics commonly include the EBITDA, earnings before interest, taxes, depreciation, and amortization. We have a video about that. The revenue or the net income, depending on the context. Now, the real magic behind multiples lies in their ability to provide that comprehensible and methodical approach to assessing a company's value. Also, it considers its financial performance alongside established industry benchmarks. This process enables prospective buyers, sellers, investors, or financial analysts to be able to paint that clear picture of the company's position in the market. By looking at the multiple and understanding how it interacts with the financial framework, you're able to gain insight into the business's overall health and standing. The application of multiples is important because it empowers you to make those data-driven decisions and also ensures that it's a balanced perspective in the dynamic landscape of business valuation. Multiples, they're kind of like those spices in a seasoned dish. They come in various flavors, and each highlights a distinct facet of a company's financial well-being. In today's video, let's delve into 3 of the most common multiples, each with its own unique application in the world of business valuation. First, let's look at the price-to-earnings ratio. This fundamental metric connects a company's stock prices with its earnings per share, the EPS, serving as a window into investor sentiment. A high PE ratio suggests optimism about future growth, while a lower ratio indicates a more cautious outlook. Understanding this ratio provides insights into the risk-reward balance in the stock market. Next, we have the enterprise value to EBITDA, the EV/EBITDA ratio. Essentially, it is for mergers and acquisitions. This ratio considers the company's overall value, including the debt, the equity, and relative to its earnings. It provides that holistic view of the profitability, considering all the intricacies of the capital structure. This makes it an important tool for investors and buyers that are seeking to evaluate a company's worth beyond the stock performance, especially in significant business transactions. Third, we have the price to sales, the PS ratio. For early stage companies or those yet to turn a profit, the PS ratio is a go-to multiple. It gauges a company's stock prices relative to its annual revenue. The absence of earnings doesn't hinder the assessment of its value. Instead, this multiple focuses on that top line, examining how a company is faring in terms of sales. The PS ratio gives you a glimpse into their market potential and how investors perceive their growth prospects. It's also a fundamental metric for anyone that understands the value of companies in their early stages of development. Now, here's where things get fascinating. To calculate these types of multiples, you need to collect the necessary financial data from the business that you are assessing. For instance, to calculate the PE ratio, you'll divide the market price per share by the earnings per share. The result is the figure that tells you how much investors are willing to pay for each dollar of earnings. Now, multiple values aren't set in stone. They can fluctuate significantly based on various factors, such as industry trends, economic conditions, company growth, prospects, competitive landscape, and even interest rates can all influence the multiples. It's important to keep these factors in mind when you are evaluating a business. Let's put the theory into practice. So imagine you're looking at a tech startup with a promising growth trajectory. To assess its value, you would probably use the EV/EBITDA multiple. You'd first determine the enterprise value, which includes the company's market capitalization plus debt and minus cash and cash equivalents. Then divide this by the EBITDA. The result gives you an understanding of how the company's value compares to its earnings. While multiples are great tools to have, they do have some limitations, just like everything does. It's important to know that multiples can oversimplify the true value of the business. They rely on historical data, which may not accurately represent the company's future performance. Additionally, using multiples can be misleading if the company you're evaluating actually has unique characteristics or operates in a niche market. Note that the world of business valuation is not just an art, it's an actual science. Knowing when and how to apply multiples requires deep understanding of the business, the industry, and the economic context. It's like a puzzle piece, a complex puzzle piece, and you want to make sure that every piece of the puzzle fits into place. Now, with practice and experience, you'll become a valuation maestro. But before you become that valuation maestro, you want to look at the tools of the trade. Valuation professionals often use financial modeling, discounted cash flow, DCF analysis, and comparable comps analysis, alongside multiples. By combining these methods, they can create a more accurate and comprehensive picture of the business's value. You want to make sure that you have all the financial data in place and all the tools to be able to calculate the accurate numbers to get that business's value. So there you have it, folks, the secrets of calculating multiples in business valuations. Remember, this is a journey that combines quantitative analysis, also with qualitative insights. Numbers and letters matter. Whether you're looking to buy, sell, or invest in a business, understanding multiples is an important skill. Now, with practice and the right resource and the right people, you can master the art of business valuation and also navigate this exciting world of entrepreneurship with confidence. Thank you for joining me today. If you found this video helpful, make sure you share with fellow entrepreneurs. Hit the thumbs up button and make sure you subscribe so you don't miss any valuable content from me. Stay curious, stay sharp, and see you in the next video. Bye-bye.